In Chapter 23, we're going to talk about operational budgeting. So let's go ahead and get started. And we'll talk by mentioning Hilderic and Bradsby. They started as a small woodworking shop in 1856, and by the 1920s, they developed a bat. And even in the 1920s, they were making 1 million bats per year. And they are the manufacturer of the famous Louisville Slugger. And we start by talking about them in terms of a business that uses budgeting. What are budgets? Why are they important? Well, they assign decision-making authority over the company's resources. They coordinate and implement plans across the organization, and they hold employees accountable for the results of their decision-making. For the first part of this lecture, we're going to talk about budgeting for NTI, Network Technologies Incorporated. They make or manufacture a screening device designed to safeguard personal computers against viruses. Okay, they have struggled for the first 9 months of operations. However, the company experienced a very strong fourth quarter and done well, and essentially had a high net income. Okay. So let's see, they're profitable, yes, but cash poor. And so you can see they have a huge gross margin percentage, large net income, very solid, especially as compared to the industry average, 29% return on equity, and 15% return on average assets. And while they appear to be profitable, they have some cash flow issues. And so we note that by using some cash flow measures like current ratio that compares the current assets to current liabilities, much smaller than the industry average, as is the quick ratio. They have very slow inventory turnover, and they're not so good at collecting receivables. So let's see what they have done or what they need to do. All right, in response to a surge in demand experienced in the fourth quarter of 2027, NTI dispersed large sums of cash to manufacture goods available for sale. So a huge amount of surge in demand. They went and literally tied up their cash in making a whole bunch of goods available for sale. Is that bad? Is that good? Well, I guess it's good, but now their cash is tied up, and so they can't use cash for other purposes. So how does this work? Well, as shown here in this diagram, their operating cycle from when they invest cash in their products until they receive cash is 247 days. So throughout this operating cycle, they have to continue to pay payroll, materials, purchases, service the debt, overhead costs, and they've got to do that on a timely basis. But they recorded a negative $250,000 negative cash flow from operations. Okay, so let's see how budgeting might help with that, or the impact of budgeting here. So what is a budget? A budget is a comprehensive plan setting forth the expected route for achieving financial and operational goals of an organization. So we see that there, even the smallest business would benefit from a plan, and virtually all economic entities use a formalized plan and are in some form of budgeting. Operational budgeting for multinationals can be very complex. For example, Yahoo has global operations in 25 worldwide locations in more than 30 languages. And so this can make a very complex process to try to forecast exchange rates and how that might affect and impact revenues, assets, liabilities, and expenses. What are the benefits derived from budgeting? Well, it gives enhanced management responsibility. It tells us who is assigned to make decisions. It coordinates activities and allows us to evaluate performance. Now, there are two basic approaches being used, or two basic philosophies used to dictate the level at which budget amounts are set. We identify these as the behavioral approach and the total quality management approach. So let's start by talking about the behavioral approach. Under the behavioral approach, the assumption is the behavioral approach will most highly motivate managers. And we want them to be motivated to make a profit. And so budget levels are set at reasonable and achievable levels, And if a department operates in a highly efficient manner, they should be able to beat their budget. But if they fail to stay within the budget, that would be viewed as unacceptable. So this would be the behavioral method. The other approach is the total quality management approach, where every individual and segment of the organization should strive for improvement constantly. The entire organization is committed to the goal of eliminating inefficiency, and the whole organization strives to achieve perfection. Okay, so that is the total quality management approach. So how do we decide which budgeting approach we'd use? Well, managers should participate actively in the budgeting process. Department managers are usually the best source of information about their departments. These managers should understand both the intended purpose of the budget and the philosophy underlying this method. Okay, so using an approach, again, we're going back to the behavioral approach here and the quality management approach here. So the behavioral approach is, hey, you should be able to exceed the budget level of performance, whereas a totally quality management is used, a highly efficient unit should fall slightly short of the budget standards. And the question is, what is most motivating to employees? Usually, or managers, I like to be able to exceed expectations. So usually when I think about something, I think, hey, set expectations low so I can beat them. And so whatever I do would beat that expected performance. There is a budgeted period. Often it'll be in months, quarters, annual budgets, both operating and financial budgets. And so that would be a common period, but long enough to show the effect of management decisions and policies, but short enough so that we can make some estimates. We also want to introduce the term of rolling budgets. Rolling budgets simply say, hey, we're always looking 1 year ahead. And so as the current month ends, we're going to roll out, 12 months from now and keep this rolling budget. And so rather than doing it once a quarter or once a year, we're going to have this rolling budget as we go. Okay, so let's talk first about a master budget. The master budget comprises two parts: the operating budget, which includes the sales budget, the production budget, how many we're going to produce, what the expected level of production is, the cost of goods manufactured and sold, as well as a selling and administrative budget, and finally a cash budget. The other is the financial budget, where we're calculating our income statement, balance sheet, statement of cash flows, and capital expenditures. You'll see this master budget and our operational budget pretty much it focuses on sales and on cost manufactured, but essentially is on the production and not necessarily on the financials. So we need to see how it might affect the financials. So let's talk about organizational budgeting here. So we start with a strategic plan. We look at our competitors, look at our economic conditions, look at our customers, develop a sales budget. How many are we going to sell? And that will help define what the production budget looks like, what the cash budget looks like. So the blue in here would be the operational budget. The green and yellow down here would be the financial budget. And so we can see how those look like and how they're divvied up. So given the strategic plan, we're going to have to do something to make sure we have the capital, the assets available to produce. So that's going to help us come up with a capital expenditures budget. This operational plan will help with a budgeted statement, budgeted income statement, and given these various parts, we're then able to put together the financial budget. So generally, we'll start off with a sales forecast, and that gives us, first of all, we're going to do our operational budget, what operations are going to be affected, and then once those are set, as mentioned here, once we have this operational budget, then we have the components we need for the final, budgeted income statement, budgeted balance sheet, and budgeted cash budget. Okay, so let's use this illustration here for NTI. They need a budget for 2028. Primary objective of the process is to avoid the cash flow problems that they recently had, right? They put it all into inventory, weren't super productive or didn't sell it that fast and didn't collect it that fast, and so we've got to try to address that. So sales of NTI products are expected to increase throughout 2028. However, the company will drastically cut back the production and to get rid of or sell off the inventory they had on hand. So as of January 1st, there's no work in process inventory and no capital expenditures planned for the next year, possibly because we don't have cash, right? And so we're going to look at the balance sheet. Here's the beginning balance sheet. Here's what we look like. Notice we have very little cash. We have quite a bit of ending inventory sitting here. We've got some loans. We've got a note payable due in 3 months. And so we note that. And so this is kind of our starting position. So in preparation for the budget process, the cost accountant has thoroughly analyzed the variable and fixed manufacturing cost. Here's the cost of the direct materials. Here's how much direct labor we have to put in. She doesn't think the variable manufacturing costs are going to increase and that the fixed manufacturing overhead will hold steady. So that allows us to come up with a cost estimate per unit. So these cost estimates suggest the variable costs are here: direct materials, direct labor, and variable manufacturing overhead, as well as the fixed manufacturing overhead. So we expect that to stay steady. So given this, we're going to determine our sales budget. So Bob Poole, the marketing director, thinks the demand for the product will continue to grow. It will be 8,000 in the first quarter, 10,000 in the second quarter, 30,000 in the third quarter, and 40,000 in the fourth quarter. Seems pretty optimistic, but we'll go with that. To keep its products affordable to a wide range of users, we're going to hold the sales price steady. And so given that, here are our number of projected sales. Here are our sales price per unit. So we're starting to build up what our projected revenue would look like. Okay, so given that sales budget, now we've got to have a production budget. So we start and we say, okay, upon examining performance reports, NTI's production manager concluded that he overreacted on the rapid sales growth experienced in the fourth quarter. And so given all that, the policies, the estimates, we're going to move forward. So projected unit sales is 8,000, and we want to have 1,000 left in any inventory. So units available for sale would be 9. And we want, we have beginning inventory of 8. So we need to produce 1,000. So notice the desired ending inventory is the same as the beginning inventory of the next quarter, right? So this 5,000 in the third quarter, ending is the 5,000 in the beginning. So this tells us what we need our production to be, okay? And so let's keep going forward here with this. And so here was how many we concluded we would need in budgeted production. And here is how many of each of these items we need in terms of direct materials, how many labor hours we need, how much overhead we need. Okay, and these are all based on our cost estimates of how much we would need. Now you'll want to look at these in some detail to be able to see, but they're based on the projections and the cost estimates we've made thus far. Okay, so given that, we're then able to put together our cost of goods manufactured as well as our cost of goods sold for each of these periods. This tells us how many we produced, what the costs are associated with each of them, and then what is the cost of goods sold for each of these. So you can see this dramatically increases because we're expected to sell quite a few more units. And so we could see what that looks like here. Okay. All right, next would be the selling and administrative expense budget. Okay, so what is our expected amount? Well, $750 per unit sold. And so we could go back and see what that looks like. So going back a few slides here, they're selling for $75, but it's $750, and sales and administrative expenses 8,000, 10,000, 30,000, 40,000 units. So 8,000 times 750, and let's go and look at this. 8,000 times 750 would be 60,000. 10,000 times 750 would be 75,000. Okay, and then we extend that further for the third and fourth quarter and see what they look like. So we're slowly building this up to create a full budget and see what it looks like for each of these. Okay, so we then are able, once we have our operational budget complete, we're able to come up with a budgeted income statement because we know sales, we know cost of goods sold, we know selling administrative expenses, and management is going to help us determine interest expense and income taxes. So given that, we're able to put together a budgeted income statement here for each of these component parts. So we know sales, we know cost of goods sold, we know gross profit, we know sales administrative expenses, and we are given how much our interest is. That gives us an operating income before tax. Our tax rate is 40%, and that allows us to determine net income. And so we can see how these various component parts allow us to put together the income statement. Now, we said that we don't plan on any additional capital expenditures, so that helps make this a little simpler. But we now have to determine our cash budget. Okay, and we're going to use what we know about our company and what I know about our budgeted performance operationally to come up with a cash budget. And that's going to include disbursements for payables, prepayments, debt, and taxes on the cost side. And we also have cash receipts when we sell and ultimately collect our receivables, okay, that we've sold. So let's look at the current payables budget. Our preparation of a cash budget begins with an estimated budgeted costs and expenses, which we have, right? We also recognize we have certain expenses that will not require an outlay of cash, and that includes depreciation and anything that we have prepaid in advance, prepaid insurance, for example. However, only those costs and expenses financed by current payables will require cash payments. Okay, so we're not really worried at the moment about a long-term debt. We're going to be interested in those financed by current payables. Okay, so let's see what those are. Okay, so we have a beginning balance of payables. That becomes from our initial income or balance sheet at the beginning of the year. So that was $50,000. Here are our additional materials purchased, direct labor used, overhead, selling, administrative expenses, and so it suggests that our payables have gone up to $277,000. But we prepaid insurance, and we have property, plant, and equipment that we are depreciating. So that will reduce it, and so our total current payables will be $318,000. And we want our ending balance in accounts receivable to be $75,000. So that's going to require $243,000 in cash. We also have some prepayments that we need to make. Okay, so we had $5,000 at the beginning of the quarter. We're going to have some cash expenditures for these prepayments, and some are going to be used up. So we have $7,000 at the beginning, and then we work through the process. So whatever at the end of one quarter is the beginning of the next quarter. End of one quarter, beginning of the next quarter. And so we can see what that looks like. And so we can see what our estimated cash expenditures are during the quarter. Okay. The next one is the debt service. Okay, so the purpose of this schedule is to summarize the cash payments, both principal and interest required to service NTI's debt each quarter. NTI has 2 notes payable outstanding, and this says how many of these are going to require cash to pay off. So the 12% $36,000 note payable is a loan from Nancy Conrad. The loan agreement calls for quarterly payments of $9,000 plus interest. And so $9,000 plus interest would be $9,000 plus interest of $1,080. Do note that this is a quarterly rate. Usually when you see rates of interest, it's going to be an annual rate, but this is a quarterly rate. So 3% of the $36,000, $1,080 for $10,080. And it's going to go down a little bit because we've paid off some of the principal. And so we're going to now $36,000 less the $9,000 principal. Second quarter would be $27,000, and so the cash outlay would be $98.10. Now there's also a second loan that we have to service, and that second loan is $246,000. It's due at the end of the first quarter, so we have to pay that $246,000, and we have to pay the interest of $86.10. So we're going to take that $86.10 and add the interest from the first quarter here, so that'd be 8610 plus 1080, and so we can see that included here. And so we show how much we have to pay, and we can see that is 254,610 for this one, and then we have to add to that the 10,080 that has to be paid. So you can see how we're putting this together by looking at the various component parts. The next part is budgeted income, and this comes from the income statement. We see the income tax liability at the beginning. We see our estimated income taxes this quarter. We argue we've got to pay the $64,000 that we owe at the beginning during the quarter, and that gives us liability of $46,124, which is the amount we've got to pay this quarter and the next one, and you can see the $409,222 here. And so we can see what the cash payment was and see the income tax liability included there. All right, we've mostly focused now on the expense side, but we also receive revenues. So the credit manager suggests we should be able to collect the entire $225,000 of accounts receivable that was owed us as of January 1st this quarter, and then collect 75% of the quarterly sales during the quarter and 25% the next quarter. And so we're kind of setting this up to see what this looks like. If successful, Baker estimates that NTI's average collection period will then be reduced to 30 days. Excellent. Okay, so your turn. Assume you are manager of NTI's credit department. Nancy Conrad, the founder of NTI, has asked you to manage receivables and payables by leading and lagging. Leading receivables implies collecting cash from customers more quickly, and lagging payables means delaying payment to creditors. You're concerned that what Conrad is suggesting is unethical. Well, there might be various views on this. Certainly, there are practices to try to line these up consistently, that you're getting money from customers and that's pretty close to the money paid to creditors. And sometimes you can explain that to your suppliers what you're trying to do, and certainly is a practice that has been used. The next is now to see how that budget of accounts receivable collections turns into our cash budget. So we started with $225. We hope to get that full $225 during the quarter. We're going to sell $600,000. You remember we're trying to get 75% of that in this quarter and 25% the next quarter. And so we expect to see $675, and that would give us an ending balance of $150. So here we have the various components of what we've just discussed. We had a cash balance of $10,000. That comes from that initial balance sheet. We have cash receipts of $675. That just comes from here, the last slide, making total cash available to be $685. And then we're going to pay off our payables, prepayments, debt service, and income tax. And we should have a cash balance at the end of the quarter. So we're going to, should everything turn out how we expect, we should be able to go from $10,000 to $107,000 this quarter. And this then allows us to set up to come up with a budgeted balance sheet. Now you're going to want to go through this in some pretty good detail, but you can see how this refers to each of the exhibits we've just worked through, and you're going to be able to see how that goes, even down to the income showing up in retained earnings for the quarter. Okay, you can see that our expected cash is supposed to dramatically increase. You're going to see our profitability is expected to increase, and so that all looks good. Now, what are the benefits of budgeting? Well, advance warning of and assignment of responsibility. NTI now knows that one result of expected increased sales is a large increase in needed direct labor hours, from 400 hours in the first quarter to 10,000 hours by the fourth quarter. So we see we've got a plan for that. We've got some advanced warning. Should these sales projections work out, we need to start hiring a bunch of employees. Okay, that's one thing we can note. We also want to work to coordinate activities among the departments. The increased demand for direct labor requires significant coordination with the administration and the manufacturing department. We may need to do more than one shift or find additional production space to accommodate the additional workers. Okay, and that might have some cost implications as well. All right, another benefit is this sets some standards for evaluating performance. Because Lisa Scott, the cost accountant, analyzed direct labor required to produce a final unit, the company now has an expected standard cost. How long does it take to produce a finished unit? 1/4 hour. And so this is what we're going to use to plan how many employees to hire and to evaluate how efficient our current employees are. All right. I want to talk a little bit about a flexible budget. We've talked about a master budget where we pretty much set, here's the expectations. But sometimes there might be a change in volume. We might not sell as many in the first quarter as we expected, and that might have a cascading effect, meaning we're going to sell less the second, less the third, less the fourth, and so we may need to adjust based on that. We call that a flexible budget. It's one that can be adjusted quickly and easily to show what the budget revenues, costs, and cash flows would be at different levels of activity. And that is how we would use a budget that way. Okay, so NTI's performance of the production report. So this is what we budgeted. Here's what we actually did. And so here is where we're over. So we doesn't make it clear if we made additional units yet. But we had actual costs. Hopefully that's because we produced more than we expected and can thus sell them. And here it is in each category. And so this will help us manage the business and say, okay, what was it? Were we not as efficient? Was the standard cost too high? What should it be? And so let's go ahead and look at the level of production. Okay, so this says, hey, if we did 500, our total manufacturing cost should be 28,500. If we did 1,000, and our flexible budget planning, 42,000 and 1,500 would be 55,500. Okay, so based on that, we originally budgeted for 1,000. We actually made 1,500. And so here's what the budget would have said if we did 1,500. Here's our actual cost. So we did a little bit better than expectation in creating those. So, being a little bit of a skeptic here, I just want to make sure we can sell all those, right? And so we did make more, and can we sell them? Okay. As we adjust the entire budget to reflect a different level of sales or production would be a sizable task in a manual system. But in a computer-based system using predictive, prescriptive analytics, this becomes quite a bit easier to do. And so that's how a flexible budget would be used.